Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and in the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HYROX, who does some really good bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, as well as his timely call on adding 30-year Government of Canada bonds to our fixed income model. He continues to add value to our portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. And we will have a question and answer period at the end of the call. So if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. As we do each week, let's quickly recap our themes for 2016 before we get started on what happened over the course of the last week. Now, our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility, but markets did settle after that thanks to continued central bank monetary stimulus. Volatility bounced back post-Brexit, and although it has calmed again, we think it is far from gone away. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spent a good deal of our efforts trying to determine how the U.S. economy will evolve. The U.S. economy barely scraped by in the first half of 2016 with an annualized growth rate of about 1%. Now, things look a little better at the moment for the third quarter, but that is how the second quarter started before it fizzled. The low inflation and deflationary pressures continue despite the efforts of central banks. Stimulative central bank monetary policy on its own has not succeeded in reigniting global economic growth. Geopolitical uncertainty has become a major factor. Brexit and the rise of populism in developed nations, the United States presidential race, terrorism, and instability in some countries are all having an impact on the consumer, on business, and investor psychology. There has been a flight of capital into safe government bonds, driving prices higher and yields to record lows and producing negative returns. Equity market prices have been comforted by central bank monetary policy stimulus to combat the potential for additional volatility. But at current levels, they are as expensive in terms of earnings and valuations as they have been, and our comfort level with this asset class continues to remain low. And with no clear economic direction, businesses tend to postpone investment decisions and consumers postpone spending decisions until they can get a better sense of what to expect in the future. We are in a time when the risk-free rate of return is close to 0%, which means that to get the higher returns that they want, investors are taking on more risk, likely more than what would be wise. We think that this makes for a dangerous situation for investing and that caution should be the order of the day. Okay, so let's have a look at what has been driving markets over the last week. After spikes in January and February and again in June, volatility has hit its lowest levels this year, but it will not last. Historically, when it gets to these low levels, the next move is usually to the upside. So we can expect some volatility to appear in the not too distant future. As well, the Fear and Greed Index has moved, after moving up to what we would classify as nosebleed territory in the 90s, has now slipped back to still extreme greed, but a lower level at 79. And again, if the history of these movements is any indicator, the last time it got this high, it moved lower and rather quickly after that. So what do we think is next? Well, the next move we think is to see markets get sold off. But since our last webinar, our benchmark world equity index is up a little over 1.5% since on the week, and about 5.25% on the year. Germany's DAX index was the best performer since last Tuesday, and Australia's All Ordinaries index was the worst performer. The Canadian TSX continues to be the best performing country index in the developed world this year. China's Shanghai Composite has been the worst performing index. Well, buyers continue to push prices above the long-term downtrend upper band of our benchmark all country world index as stock markets rallied further last week. Volume, however, remains light and limits our enthusiasm. The year-to-date total return for this index has been 6.83%. The one-year return has been a 1.58%, the three-year return 5.93%, and the five-year return 9.21%. And if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity and 40% bond index combination year-to-date is 5.26%. 1.38 for 1 year, a little over 4.5 for 3 years, and a little over 6% for 5 years. Now, for a less risk-oriented 40% equity, 60% bond combination, the year-to-date return is 483. The 1 year, about 189, almost 4.5 for 3 years, and a little over 5% for 5 years. By comparison, a client who started with us in January has a total return this year to date after fees and costs of 6.33%, nicely ahead of the benchmark that we just showed at 5.26%. So a little over 1% better than the benchmark. Canadian Preferred Share Index and the U.S. High Yield were higher as investors moved to more risky assets over the course of the week. Canadian bonds and government bonds, U.S. and Canadian government bonds were little changed over that week. Oil bounced this week, but all other commodities were lower. As I said, oil bounced off of that $40 area. Paul's going to talk about this a little later, but he was active in the tactical portfolio with energy names over the course of the week. And the Bloomberg Commodity Index has been testing the lower band of its uptrend channel. The Broad and Diversified Benchmark Equity Index, upon which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. With over 50% of the companies in our benchmark domiciled in the U.S., we keep a close eye on what's going on there. And first to the political scene in the race to the White House, Trump has struggled over the course of the past week and slipped significantly in the polls. Well, the U.S. employment growth was better than anticipated for the month of July. It has been cited as one of the reasons that stock markets jumped following the announcement last Friday. It is important to remember that it is just 1 month data, and as you can see from the month-to-month numbers, it can be erratic, and revisions can also be sizable. So it is better to regard this data over a longer period of time. The 12-month moving average, that purple line, helps to smooth out the volatility from the month-to-month numbers. And as you can see, employment growth peaked in early 2015 and has been declining ever since. Now, the probability of a Fed hike in September jumped following this data release, but from 0% chance to a 26% chance. The U.S. economy is now expected to show GDP growth of about 3.7% for the third quarter based on data received so far this quarter. Part of that can be attributed to the employment data that we saw last Friday, and part of that can be attributed to better inventory to sales ratio at the wholesale level. But as we have mentioned here a number of times, historically when the 3-month moving average unemployment rate converges with the actual unemployment rate, a recession has followed. The 3-year moving average is declining at a rate of about 0.1 to 0.2% per month. So that is only 4 or 5 months until it moves from its current level of 5.8 to 5.0. Now, last Friday, the unemployment data in the U.S. remained unchanged at 4.9%. But the U.S. unemployment rate remains the same or moves a little higher while the 3-year moving average continues to fall. A recession will likely follow shortly thereafter. And that is something that does worry us. Elsewhere in the global economy, Brexit and the potential political and economic fallout are still well on our radar screens. Unfortunately, it may take some time to determine what exactly will be the end result, but until then, there will certainly be plenty of speculation and uncertainty. Last week, the Bank of England launched a huge new stimulus package in order to mitigate the damage the Brexit vote would have on the UK economy. The package included a 25 basis point cut in the bank rate to 0.25%, the purchase of up to £10 billion of UK corporate bonds, and expansion of the asset purchase scheme for UK government bonds of £60 billion to £435 billion. Now, as a result, the pound has fallen back to its post-Brexit lows. In the euro area, the market Eurozone Purchasing Managers Index Composite Output Index tracks business trends across both the manufacturing and service sectors based on data collection from a representative panel of over 5,000 companies, 60% from the manufacturing sector and 40% from the services sector. The index tracks variables such as sales, new orders, employment, inventories, and prices. National data are included for Germany, France, Italy, Spain, Austria, the Netherlands, Greece, and the Republic of Ireland. A reading above 50 indicates expansion in business activity, and below 50 indicates that it is generally declining. Well, the current numbers suggest that the region saw little overall contagion from the UK's Brexit vote. The recovery is increasingly being driven by Germany, where activity grew at the fastest pace in 7 months. Now, in contrast, French activity barely increased during July, while Spain's composite PMI fell to a 32-month low. Now, if sustained, that divergence would make it more difficult to find a monetary policy that suits both Germany and the rest of the European zone. Well, evidence on the impact of negative interest rates in Japan is trickling in, and except for a brief jump in February, households are not increasing their spending, which then becomes a question of the psychological impact on the consumer of the policies that the Bank of Japan is following. The debate over the impact of negative interest rates continues. And here at home, after 3 months of little change, employment declined by 31,000 in July. The employment rate increased 0.1 of a percentage point to 6.9. Full-time employment fell by 71,000 from June to July, while part-time work was up by 40,000. Compared with 12 months earlier, total employment increased by 71,000 or 0.4%, with all of the growth in part-time work. Employment in Ontario alone in July decreased by 36,000, the first notable decline since September of 2015. So Ontario employment data looking a little grim there. In China, Chinese exports saw a further decline in July, adding to concerns over the global economic outlook. Exports fell by 4.4% compared to a year earlier, which was a slight improvement over June's 4.8% drop, but still worse than analysts had been expecting. Imports were also weaker than estimated, down by 12.5%. As China is a crucial driver of the worldwide economy, the data is seen as a snapshot of the global outlook, and the country's exports have fallen for 12 out of the past 13 months. The global uncertainty ranging from low commodity prices to the EU debt crisis and the UK leaving the European Union continues to weigh on economic activity around the world. Well, where do we see all of this taking us? Let's check in with the bond markets. In the U.S., short-term yields were up on the good employment data, but longer-term yields were flat to lower. That flattens the yield curve a little, but basically is just reversing what happened the week before. After the Bank of England rate cuts, the whole curve shifted lower by close to 25 basis points. The inversion of rates in the front end could indicate some concerns about recession coming in the next couple of quarters. German yields declined and are now below zero out to about 12 years. And the Japanese yield curve steepened further this week, indicating a little more economic confidence, and that could be on the back of the Japanese government's stimulus plans. In Canada, weak employment data pushed yields lower. Well, as for equity markets and their value, it is earnings season still, and we are now coming close to the end of the second quarter results. As we discussed on previous calls, historically companies like to underestimate earnings in order to show positive surprises to beat expectations. It's good PR, but the 5-year average beat is 67%. Well, after 86% of companies have reported, there has been an above average 69% of upside surprises, so just a little bit more than the average. The combination of expected and reported growth is a negative 3.5, which is better than the June expected growth rate. Now, if we factor in the average beat, this should lead to growth of negative 2.8% and the 5th consecutive quarter of negative earnings growth. Why are earnings important? When investors buy stocks, they buy a stream of future earnings which go to pay dividends or are reinvested in the company. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings, and there are a number of metrics, and if you read or have read Paul's blog, there are probably more telling metrics that we can look at. This is a more popular metric that we tend to follow, but there are a number that we do follow on a continuous basis to tell us where there is value. Now, the price-to-earnings ratio average over the last 10 years has been 14.3 times. The 12-month forward price-to-earnings ratio is currently at an expensive 17 times, and that is a pretty significant difference over the average. More importantly, earnings have not increased since 2014, but share prices are up by over 10%. We think that makes current share prices very expensive and a reason that we do think it is reasonably underweight in our exposure to this asset class. And as I mentioned on yesterday's blog, this year alone, earnings for the year have been revised from an expected rate of growth of 6% at the beginning of the year to currently a negative 0.3% growth on a year-over-year basis, while stock prices have actually risen by just a little under 7% in the S&P 500. So again, we think that that suggests that stock prices are considerably overvalued at this point in time. And what does it all mean? Well, again, as we say each week and have been saying for well over a year now, we continue to take a cautious and defensive posture to investing, and it has been good for our clients and certainly for ourselves. Remember that we are investing in the exact same models and securities as you do. Now, we monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there's value, we will remain patient. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see reasonable opportunity. Others may be willing to take on greater risk. We are not. And as I say each week, cash and cash equivalents have been and continue to be important defensive assets, so we are still carrying greater than average cash balances in our models. Now, if we can attain better than benchmark returns, having more cash and less exposure to risk, we are taking smarter risk. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. Now, here's a question that I received earlier this week. If you are so cautious, aren't you missing out on the rally as equity markets hit new highs? Well, the answer, in a nutshell, is no, we're not missing out. We are taking less risk and still getting better than benchmark returns, which means significantly better risk-adjusted returns than those who are fully invested and are exposed to greater amounts of risk. That is how we add value. If, as we suspect, stock markets correct to the downside, our models and portfolios will give back less and keep more than the higher risk buy and hold strategies. Okay, so let's ask Paul if there's anything new with our tactical model over the course of the last week.
Thanks, Scott. And just even going back one slide, I guess one of the ways that we are keeping track and outperforming against the benchmarks that we follow is by virtue of the fact that we have a tactical model in our portfolios on the next slide. So we've been that tactical model is almost fully invested to our ideal weight, ideal model, and without getting into details as to what is in there, we can tell you that it is roughly 50% in common stock, and the balance is in some very specific high yield bonds, and even a convertible bond and a preferred share. And I just actually finished writing this afternoon, we'll publish it shortly, a very long blog on the capital structure of a company and how we trade around different parts of the capital structure of a company to get the best value and best risk-adjusted returns. So you can read that at your leisure. But just within this, recently I can tell you, well, say even over the past couple of months, we have added a little bit of energy exposure in some equities. We have done a switch trade where we sold some common stock of company A, and we bought a convertible bond of company A. So we moved higher up the capital structure, and there was a very specific reason for doing that. So we are, that's where we're adding a lot of value to the overall client portfolios and our performance on a year-to-date basis, and hopefully we can continue to do so. We'll continue to work hard at doing the research and putting on the right trades. That's it.
That's great, Paul. Thanks for that update. And I will add that one of the things that that I've been looking at personally in my portfolio, and I encourage dialogue with all of our clients from that perspective, is thinking about adding a little bit more tactical exposure to the portfolio, because in our view, the global equity market is pretty much what we would classify as being generally expensive. So if there is a correction in the market, we certainly have lots of cash in that particular model to take advantage of lower prices when they happen. But in the interim, while we wait for that to happen, it is the tactical model that is adding, as Paul said, lots of good value to our overall portfolios. And so, as we showed before, we are outperforming our benchmarks to a great degree because of the tactical, the impact and the input of the tactical model. Anyway, thanks for that, Paul. And that is it for today's discussion. And we are not going to be hosting our next webinar until the 30th of August. So hopefully all of you listening will take that and mark it in your calendars. We certainly would like to wish you all a happy rest of the summer. But in the meantime, we'll certainly be monitoring all market developments and client portfolios, but also trying to get in a little summer R&R for ourselves. I'm going to be in Vancouver visiting with clients and prospective clients over the next few days, and I'm very much looking forward to seeing you all. As always, I want to take the time to thank you for taking your time out of your busy schedule to tune in. Don't forget to tune back in on August the 30th. But until then, this is Scott Tomlinson signing off.